folks. I hope you've had a good week and looking forward to a good weekend. Yes, it's been a fairly decent week for the markets. Optimism about the ceasefire has percolated through all the markets, and there's a lot of optimism that this will work. In any case, equity markets have been stable and even on the upside in many cases. The US markets are pretty excited. European markets are pretty happy. Indian markets reasonably happy, and even other emerging markets are reasonably happy about what's happening on the ceasefire. Right? Oil prices have been correcting more than 10-11% down, and that is one place where I can see the immediate impact of any ceasefire. Okay, while it falls on good news, it rises back as quickly on any kind of uncertainty. So while a lot is hinging on the optimism that this ceasefire will continue in the medium to long term, you know that things can go wrong at any point of time. A tiniest mistake in somebody's statement could upset the entire carefully built apple cart. Okay, so let's always keep that in mind as we look at markets. So the business standard says credit and deposit growth fastest since FY24, which is very good news. Okay, so bank credit has grown by 16.08%, and surprisingly, even deposits have grown. Aggregate deposits have grown 13.47%. Okay, so last few years, since almost 2017, we've been struggling with low deposit growth. Okay, and if we have credit growth combined with low deposit growth, it's going to push banks to raise interest rates, lending rates higher and higher as resource mobilization becomes difficult. But thankfully, the recent data shows that deposit growth has been pretty reasonable. Okay, that's some comfort. Also, I guess when equity markets or stock markets are a little weak, a lot of savers do go back to the banks to put their money in rather than take that risk in equity markets. It's not the right attitude, because one needs to do this with a proper asset allocation in mind. What has to go to banks will always go to banks, whether markets are good or bad, and what has to go to equity will always go to equity, whether markets are good or bad, but not the bulk of the population. The bulk of savers and investors don't think in such a rational manner, right? Which is why these things tend to happen. Okay. But in any case, for us, we are seeing this good news that we're having reasonable resource mobilization along with credit growth. So also there's a headline here that says FY26 exports grew despite tariffs, but war impact looms. So exports have been up about 1.1% as compared to the last year, which is good. With all the tariff hassles, the Middle East war, we thought exports would have got hit. We have not grown as much as previous years, but we are still all right with this thing. Okay, and I'm sorry if a bit of noise is coming in from outside. I'm in Tamil Nadu, and elections are around the corner, so every now and then I have an auto or a cycle going and blaring in about the benefits of this party or that party and how it's going to improve everybody's lives forever. And you know what these promises mean, correct? These promises unfortunately mean nothing, and we continue to suffer in terms of basic necessities, in terms of infrastructure, in terms of governance. We still hope that these things would improve. Sorry for that sudden rant. Okay, inflation, wholesale price inflation has come in at a 38-month high at 3.88%. Okay, for much of last year, this was actually negative. Can you believe it? We've spoken about it, and we said this is also pointing towards lack of demand, and now we have it at 3.88%, and obviously this shows that input prices for manufacturers is going up, input prices for producers is going up. So this obviously means that over the course of the year we will see this trickling down to the base level, and we'll also see retail inflation creeping up as long as WPI remains up. So let's not get shocked if that happens. Of course, the Reserve Bank in its monetary policy did forecast a slightly higher inflation for the year. And then there's one tiny piece here on the front page says Datanomics. Okay, it says rupee weakens, Indian economy slips to sixth largest. Okay, so here we were talking about taking the fourth space, right? And we have slipped to number 6. And why did that happen, my friends? It's because economies are measured in dollar terms. Okay, and the Indian currency slipped more than what was anticipated in the last 1 year, correct? And other currencies have not slipped as much as the Indian currency. So obviously, if we were measured in dollar terms, we would be lower because our economy did not grow at a rate higher than our rate of currency depreciation. So this is bound to happen, which makes us wonder, right? Uh, is this the best way to measure the size of the economy? And maybe that's a topic that we will take up some other time. But yes, in dollar terms, we've moved to the 6th place, and we're going to have a tougher time going back up always. So the ET Wealth has something beaten down but not broken. That's the headline. And here we are obviously talking about the stress that Indian stock markets have undergone. And the last financial year was a minus 3.6% on the stock market, on the Nifty. And this was the worst in 6 years. Okay. It happens. It's cyclical. There's always a reason for it to go down. There's always a reason for it to go up, but we're going to see both in a cycle. And yes, we did see this. But what rankles a bit is that while Indian markets were down minus 3.6% for the last financial year, there were many markets that were positive. Not just mildly positive, well positive. Okay, so Japan delivered a 45.6%. Hey, we were talking minus 3.6 for India, and here we have Japan at 45.6, Brazil at 39.2, and then the UK at 17.3, the Shanghai Composite of China at 17.2, and the S&P 500 of the US at 12.6%. And we had India at 3.6 minus, which again just makes the case stronger to have a well diversified portfolio, not just by market cap and sector, but we should also have a well diversified portfolio with respect to geographies, not just India. Do invest in all the other geographies of the world. India is just a tiny part of the entire scale. So let's not forget that. Some interesting statistics. If oil prices sustain at $100 a barrel, then we would have an impact of almost 0.5% on inflation during the year. This is as per the Reserve Bank of India. So let's keep that in mind. The RBI estimates that every $10 rise in crude adds about 49 basis points to inflation and 43 basis points to the current account deficit. There's something let's bear in mind. All these assume that oil prices will continue to remain at a high level. And obviously, if we have a ceasefire, it would not continue to be at that high level. But no harm in thinking of the worst case scenarios. Bond markets, which I had even discussed last time, had anticipated this and worked it into the prices, because from 6.84%, the 10-year Indian bond yield went up to beyond 7.1% and then corrected back to about 6.89% on news of oil prices falling. Okay, so these things happen and markets factor in the various developments, which is fine. Okay, and there was one interesting thing in the earlier article about India falling to the 6th place, and let me get that data table out for you. So the International Monetary Fund has made these projections, and for 2025, the rupee had depreciated by 4.6%. Okay, and for 2026, another 4.65% depreciation. But in the years 2027, 28, 29, 30, and 31, the projection of the rupee depreciation is only about minus 49% to minus 0.26, minus 0.08%, minus 0.47, and minus 0.67. That is all. Okay, so it is quite likely that the rupee has swung to an extreme. I mean, see, even last time we were talking about the real effective exchange rate, correct? In the last wrap, and we did speak of the overvaluation of the rupee in the previous few years, and then some correction that has happened. So once it gets corrected and the inflation differentials are low, we don't face too much pressure on flows, then it's quite likely that technically speaking, the rupee would not depreciate by more than 0.5% every year because of where the inflations in both the countries are. Okay, so let's bear this in mind. It's very important to work this into our calculations and projections, especially if you're having any dollar exposure. An interview with one of my favorite fund managers, that is Shankaran Naren, the CIO of ICICI Prudential, and headline says, "This is a good time to initiate SIPs, but do not expect post 2020 returns." Okay, let's see what he means by this. But well, some of the important points made in this article are: valuation indicators are now flashing green for the first time since 2020. Okay, so which is why even the dynamically managed funds all at historically high levels of equity in their dynamically balanced fund. Okay, which is good to note. And he says that we recommended that investors can start systematic transfer plans into equity and can consider deploying one tranche of the investment immediately. That is, in addition to the STP that has happened. Okay. Since then, markets have rallied owing to improvement in geopolitical conflict resolution. We believe investors can consider initiating SIPs as markets are not very expensive. Okay, so historically, initiating SIPs during such times tend to be beneficial for long-term wealth creation. However, one has to be mindful that any development which hampers peace talks can lead to intermittent volatility. And as I say, intermittent volatility, I have a truck blaring its horn and reminding me that noise and the volatility can happen anytime, guys. Okay, let's go with this. So, a calibrated entry is still recommended because geopolitical risks remain. We are so unsure about how things would proceed in the future. Okay, so while valuations are more comfortable, triggers for strong market returns will depend on how global events evolve. And the other question is, what kind of returns should investors expect? Okay, and he says, importantly, many investors believe that we are in a 2020 like opportunity, that is from a COVID low. You do remember that when on the onset of COVID and lockdowns, markets fell by 40-50% in different parts across the world. Okay, and obviously there was a very sharp bounce back from that, and the market rally continued for the next few years given the kind of support that economies got from the government. Okay, and there was significant operating leverage across industries. That environment does not exist today. Okay, let us remember that, because there have been statements here and there by some investors, some influencers saying that we are in a COVID-like situation. No, that was very different. Okay, so while markets are more attractive now, we do not expect outsized returns like those seen post 2020. Okay, globally too, markets were near all-time highs in 2025, so the possibility of outsized returns is very low. Okay, the 3 and 5 year returns are already reasonable. Convincing investors that this is not 2020 remains a challenge, because many people tend to look at things at a very superficial level without going into depth. That's what he's saying. Okay. And then he also says energy prices are unlikely to return quickly to the 2024-25 levels because supply disruptions from geopolitical conflicts may take time to normalize. Okay, this could mean elevated energy prices, a weaker than anticipated rupee, and consequently a reduced likelihood of meaningful interest rate cuts. In such an environment, exporters benefit from currency movements. Import substitution sectors tend to gain traction, and currency trends become a very important factor. Okay, so I mean, a couple of minutes back, I was reading out from a table of IMF projections where rupee depreciation was not anticipated to be as high as in the past. Okay, but if energy prices remain elevated, then our import bills are bound to go up, and there would be a pressure on current account deficit, which would mean that the rupee would also be weak. So there are always two stories, okay, two sets of projections. One, if all goes well; if one doesn't go well, and reality is somewhere in between, always. And on mid caps and small caps, he thinks that mid caps have not seen a meaningful correction due to strong SIP inflows and limited stock supply. So, what does he mean by this limited supply? There are only about 150 companies which are defined as mid cap. Okay, the top 100, the first 100 companies are large cap, the next 150 companies are mid cap, and the others are small cap. So we have only a universe of 150 companies, and since retail frenzy in mid and small has been so high, right? I mean, the SIPs going into mid and small funds were more than the SIPs going into large cap. It should be the other way around. Large cap should be the core of your portfolio, be the majority of your holding, and small and mid like a small component later. But actually, SIP flows have been the other way around. So when funds receive inflows, they just can't hold cash. Their mandate is to buy stock, so they end up buying stocks as per their mandate to be invested in mid-cap companies or mid-cap stocks. So you will never see a meaningful correction as long as there's always a demand, whatever be the price, whatever be the valuation. Okay, which is what has happened. But small caps being a much larger universe, and there, yes, the indices have fallen, and for a good stock picker, they can figure out companies that have fallen more and offer value currently. But overall, I think caution is still warranted when it comes to mid and small cap companies. Okay, so he says it is difficult to predict whether mid caps will underperform given that inflows continue and the universe is limited to 150 stocks, like what I was. In contrast, the small cap universe has expanded significantly, and large caps have seen new listings and selling by foreign institutional investors. These factors explain the relative differences. And I think what he's saying is that given the a huge selling by FIIs, that was almost like, there's a chart here, 1.81 trillion rupees was sold by FPIs in the year 25-26. Okay, and they generally sell large caps because that's what they hold. Okay, they are generally present the most liquid part of the market, so if they want to exit, they can sell quickly and get out with the least impact cost. So when they sell 1.8 trillion rupees worth of stocks, most of it would be large cap, and hence the large cap stocks fall more, and out of it banking fell more because banking is 30% of the index, right? So you will find that these fell more because of reasons of selling by people wanting to leave the Indian stock markets, and not for any other fundamental issue as much. Okay, so let's keep that in our mind. Then momentum investing, which is contrary to the value philosophy, has gained ground. How do you view its rise? I mean, the interview asked this of Sankaran because Sankaran is one of the best value investors that we have in the country. So he's asking him about momentum investing, which is a contrary philosophy. And he says, we studied this and recognized that earnings momentum works well, and based on which they have a active momentum fund focused on earnings rather than price. So the NSE momentum index tracks price momentum, and it makes eminent sense to be tracking earnings also, earnings momentum. And because we know for a fact that price follows earnings. Okay, sometimes price may lead earnings, but over time the price growth of a stock is very similar to the earnings growth of a stock. So I might as well do the tracking of the earnings growth to figure out what happens. So yeah, this is what the ET wealth, the interesting part of ET wealth. And well, I mean, I'm on a holiday and I was really not very much enthused to doing the weekly wrap, being in the mood that I am in vacation. But there's a lot of interesting stuff to share this week, okay? And which is why I still got my newspaper cuttings and I thought I will do the weekly wrap. There was a very interesting editorial in the Times of India last week by Pranay Kothasthane. Very, very contrary kind of a view. Yeah. Because we've been seeing over the last couple of years, every kind of an advantage a superpower had, they were trying to weaponize. Okay, and whether it was weaponizing of rare earths and weaponizing of the dollar, weaponizing of energy, and so on and so forth. While we all know about it, what Pranay seeks to say is, why are we not looking at the stories that failed, where countries tried to weaponize an advantage they had, but it did not work? Why did it not work? Okay, so some of the case studies listed out make for very interesting reading. Okay, one on this, he says, consider how China imposed licensing requirements on gallium and germanium exports in August 2023, escalating to a complete ban on US sales on December 2024. Okay. Now, gallium is essential for making semiconductors and optoelectronic devices, and China accounted for roughly 99% of global low purity production. Okay, so in any case, should vindicate the weaponization thesis. Okay, it weaponized gallium and germanium. But what happened? While price volatility obviously happened, high purity gallium prices rose over 200% because of these restrictions. Okay, but American consumption remained unaffected. Okay, China's share of US gallium metal imports fell from 55% to 18%. What China was banking on, that they were the largest suppliers of these gallium and germanium to US, and if they had placed a control on this, there would be an impact. But it did not. In fact, other countries came in and filled in the gap. Okay, so Canada, Japan, and Germany stepped in as suppliers. Domestic recycling facilities got revived, backed by a large amount of federal funding. Okay, so what was so far underappreciated is this: international cooperation between firms and governments proved far more potent than any single country's industrial policy. Okay, so it was not American self-sufficiency that defeated China's gallium controls. It was a network that collectively absorbed the shock. Canadian processors, Japanese suppliers, German refiners, and Australian recyclers. So there was a resilience to the supply chain, and the weaponization failed. Okay, but this is not the only one. Okay, cobalt was the gallium of the 1970s. A ton of cobalt went into every F-16 jet engine. Okay, and US would import almost all its cobalt from Zaire, and then rebels occupied Zaire and they started controlling the mines. Okay, cutting supply and spiking prices. But there was no repeat of the kind of crisis that was observed in 1973, when OPEC decided to put a restriction on oil supply to the rest of the world till their demands were met. Okay, and that was a time when the world went into a recession. But higher prices of cobalt made mining in Canada, Brazil, and Australia viable. Okay, and molybdenum began displacing cobalt and alloys. So the higher cobalt prices motivated other miners to increase production of cobalt. Okay, and at the same time, because of higher prices, innovation takes hold, and countries begin to look for solutions, and that's a substitution. So molybdenum replaced cobalt and alloys. Okay, and also efficiency improvements reduced per unit demand, and military stockpiles provided an insurance. Okay, so you see, so many things come into play when you're pushed into a corner. So being pushed into a corner doesn't mean defeat. Pushed into a corner means you work on adrenaline, you look for solutions quickly, and yes, this is what happens. He goes on to say that China's rare earth export controls have already pushed international prices to 3 times the Chinese domestic levels. Under such conditions, Chinese themselves will find ways to circumvent restrictions through shell companies, third country routing, and the age old conversion of black commodities into white ones. Okay, so there will always be a way to leak. There will be always a way to circumvent these. That is human ingenuity, whether it finds its way in leaking, circumventing, or innovation. Okay. But the most critical part of this entire edit is this. He says that there is one category where weaponization will not work, and that is knowledge. Remember that. Okay. Knowledge rich choke points. This can still be a choke point if you die. Okay. So you cannot spin up an alternative ASML in 3 years the way you can productize an existing alternative or enlist allied suppliers. The distinction between commodity choke points and knowledge choke points is the single most analytical framework for supply chain policy. So governments should focus their limited fiscal resources on knowledge intensive choke points where market forces alone are insufficient. I really wish India would pay a lot more attention to this and do something to improve the knowledge levels and improve a knowledge buffer, a knowledge reserve in India. Okay, this is where I still think we are failing. We need a very strong research agenda. Now, as we speak about this kind of supply chain weaponization not working, there's another very different article in the Mint. And I mean, first I read the headline as something else, but it is why the end of the petrostate era does not guarantee peace. Okay, so if we think that we will find substitutions for oil in terms of renewable energies, maybe solar, maybe more of hydro, maybe wind, or any new technology that comes up that could replace oil. Yes, I mean, given what is happening, every country is going to work on becoming independent of such energy supplies, isn't it? That's what is logical. But is that going to give us peace? And this gentleman, David Fickling, says it won't, because today, I mean, the last few years, we had peace because of globalization. Every country was dependent on some other country, and trade overcame anything else. And which is why they would not fight. They may fight on trade, but they would not fight using military because there was a dependence on one another. And that overcame, that was the priority, maintaining the trade. If countries become independent, they will have no requirement to keep peace. It says there are examples of this already. You see countries which are becoming more independent, becoming more belligerent. Till recent, US was one of the largest importers of oil, and then they were able to figure out a way of fracking which unlocked their entire shale oil reserves, and now they are an exporter. They have enough energy for themselves, and see what has happened. They have become more belligerent and willing to use their military more often. Then we see Israel, where it used to import a lot of energy, and now the proportion of grid energy, the proportion of imports in grid energy has fallen. There's almost a 62% change in a few years between 2010 and 2022. Okay, and see how Israel is now. Okay, that's the most dramatic reversal anywhere, and it's left the country with far greater economic resilience. Since the start of the war with Iran, the shekel is one of the world's best performing currencies, up 2.6%. US, Israel, China in some cases, and China meanwhile has built an entire clean energy industry in part to reduce its need for imported oil and gas. Belt and road pipelines and railways to bypass the Strait of Malacca have been built to blunt the threat of a US oil embargo in the event of war, while dirty domestic coal reserves have been used to trade-proof the grid. If those actions have increased Beijing's strategic autonomy as intended, they'll make war more likely not less. So being connected to the other countries is what will help peace more than a lot more independence, which will make everybody more aggressive. So, yeah. So he says here that doesn't necessarily bode well for peace. Trade has long been recognized as a restraint on conflict. The commercial spirit cannot coexist with war, is what Immanuel Kant once wrote. By raising the economic cost of conflict, the deepening integration of the global economy since the Cold War has helped restrain it. And now we are going to see a whole reversal of this. Okay. And another one here in the mint, countdown to SpaceX's IPO. A rocket set on a rigged platform, asks Krishnan Ranganathan. Okay. And yes, we all know that SpaceX is the next biggest IPO at more than $1 trillion kind of valuation set to enter the market. Okay. And this has made converted investment banks to a set of drooling animals, all wanting a piece of action of this IPO. And they are willing to do anything to be associated with such an IPO, $1 trillion valuation. Okay. And so the author asks, when you have investment banks willing to do anything, how can one depend on their opinion for the public, which is very, very critical. Okay. Competition to host these trophy listings has led to extraordinary accommodations. Reports suggest that the SpaceX deal's gatekeepers, which are, that is, investment banks, lawyers, and auditors pitching for a piece of the action, have been asked to subscribe to affiliated software products such as Grok, committing tens of millions of dollars to secure their seats. On Wall Street, mutual back scratching is a heritage craft, but the scale here is a departure from tradition. It suggests a pay-to-play ecosystem where institutional friction is bypassed and service providers are forced to dogfood the issuer's ancillary products just to gain access to the priced mandate. How can we depend on these huge branded investment bankers when they're willing to do anything and compromise on principles? Okay. But while we may have a suspicion of how these investment banks have behaved, the shocking ones are going to be how index providers are going to be behaving. Okay. So when a new company is listed on the exchange, index providers generally wait and see how it pans out before including them in an index. Okay. So there's a cooling period. And also we have seen that there's always a spike in price on listing, and then subsequently even one can expect, based on past data, a 10% drop. So rightly so, indices wait to see the liquidity, wait to see the price, and then include it in the index. But with SpaceX wanting a $1 trillion valuation, index providers are also compromising on their principles and willing to change their rules to allow it to enter on listing. And generally the weightage is a function of the liquidity, the float. And here they're thinking about giving it a 4 to 5 times the liquidity as a weight. So anybody, if the indices do this, all those wanting to buy index funds will be forced to buy at a higher price. I don't know if such things happen, and then we are going to have some of these artificial intelligence IPOs hitting the road soon, all with $1 trillion and falling over themselves to be the next $1 trillion valued company. What's going to happen to indices? We go to index investing because we don't know what to buy. We go there and say, let's average out the entire market. But if you're going to end up buying companies at a much higher price than what they should be, then what's the whole point? Okay, so we have to be very, very careful. He says passive investing became the world's favorite strategy because it offered diversification, not a concentrated bet on a singular ego. Since 1980, almost every large firm that floated less than 5% of its stock had underperformed the market over the following 3 years. Index providers argue that benchmarks must adapt or risk becoming irrelevant as companies stay private longer. This is a false choice, and I agree with it completely. This is a false choice. Relevancy bought at the price of liquidity is a shortcut to a systemic crisis. Market plumbing is not neutral. The rules of indices and exchanges are the invisible hands that steer trillions of dollars. So we need to keep our eyes and ears open, never take anything for granted. Okay. And yeah, I think that's a lot for this week, folks. Have a great weekend. All the best. Good day.